Okay, as we get started, the only thing I'll mention, first of all, I want to say hello to everybody. And during the presentation, I'll ask that everybody mute and put your cameras on off, or sound and cameras on off. That's on the bottom portion of the Zoom screen. And I look forward to talking with y'all and making this a conversation even more so than a presentation. That being all said, I'm going to start with a disclaimer, but then go right into the presentation. After the presentation, we'll have a ton of time for questions and answers. In fact, questions and answers are going to dominate this. Some of you submitted them in advance of the presentation, and you all are welcome to do so during the presentation as well. There's a chat feature on the Zoom. If you click on the chat and then you specifically direct the questions to me, I almost promise, or I think I will be able to answer every question that comes up. So we're going to really want to make this a very good Q&A session. So we're going to start with the presentation, and I'll just start with our initial disclaimer. This is the basics of investing presentation, and I hope it really provides a lot of value add to each of you. Securities are offered through LPL Financial, member of FINRA SIPC. Advisory services offered through IFG Advisory LLC, a registered investment advisor. IFG Advisory LLC and Gary Alpert & Associates are separate entities from LPL Financial. So that will be the least exciting portion of the presentation. So I'm going to go ahead and get started. So firstly, let me be the first to wish everyone a happy St. Patrick's Day before St. Patrick's Day. This was just the intro to the meeting, and we're just looking forward to it, of course, and obviously we hope everyone has a great St. Patrick's Day. So I've been a financial planner for over 22 years now. And a lot of times, folks' investment approach can be broken down in one of three ways. A lot of folks prefer to figure it out all by themselves. Some just want a sounding board or a little guidance, but then beyond that, they're good. And then others just want to have as little to do with it as possible, and it's the most hated thing in their lives, and they're like, just please take this task off my hands. Actually, I think that does a good job of categorizing folks. I'll make a comment on the first one. It's okay to figure it all out by yourself. Just make sure you have adequate time to do it, because it does take a lot of research. So if you want to figure it out all by yourself, just make sure you have the time. And if you don't have the time, then looking for guidance might always be at least a part of the approach. So I've also found that in investing, everybody has a passion. And we've listed out several passions here, and to be honest, there's really no right or wrong. You know, everybody's unique, and that's what makes us all special. When it comes to investing, and when I work as an advisor, I just make sure to speak to whatever somebody's priority is. So some folks are interested in climate action, and there's a lot of new investment options in a diversified sense that people can take part in that take advantage of climate action. Some folks are very into cybersecurity, gender diversity, emerging economies, which are faster growing economies throughout the world, genomics and biomedicine. I mean, look, things are getting faster and faster in that space. I mean, we just came up with a vaccine for COVID in less than a year. Global frontier, which is countries that are even less developed. In other words, the smaller countries that are getting into maybe even a more rapid growth phase. Robotics, data, artificial intelligence. I think some folks would even probably add smart transactions or even cryptocurrencies to that topic. So it's all unique, and you don't only have to have one interest, you could have multiple interests that span all of these. So I think the most common question I receive is, are you ready to invest? And it's actually an important question to ask because most investing is long-term. So there are a lot of prerequisites that make the determination, are you ready to invest, or are you ready to invest a large portion of your savings? So one requirement is just having a steady income. You have money left over after meeting your other financial obligations. In other words, don't invest for the long term if you're going to need the money 6 months from now. Long term, when I guess if from the investment standpoint, means that you have usually a good 10 years or more to invest. You've considered the effect of upcoming personal changes such as marriage, children, or divorce. That's sad, but before investing. So basically look forward to all your contingencies. Once again, don't invest monies for the long term that you think there's a reasonable possibility you may need in the short term. And you've built up your savings, and most importantly, having an emergency fund before establishing an investment account. And I think actually that's one of the most important building blocks of this, which is have a cash reserve. A lot of times folks invest their cash reserve in riskier investments and then lose their cash reserve. And then if they have employment issues or they need the monies, it becomes a problem. So always have that cash buffer, that money that's in the bank that you're fairly comfortable you will not lose or not put at risk. Knowledge is investing power. So, and then there's a couple of resources here, Wall Street Journal app, WSJ.com. Actually, I'll give you one website which I have is an investing resource I personally use. That's one of the better I found is Morningstar.com, www.morningstar.com, like morning versus afternoon and the word star. I found that they provide excellent investment education and resources. So talking the talk, I guess this is what folks hear most often when they hear investing. People hear about the US stock indexes. So the Dow, which is the Dow Jones Industrial Average, is the oldest and best known American stock market index. What is a stock market index? It's basically an index of stocks that are companies that represent what Dow Jones feels is the best cross section of our economy. So for example, the Dow has 30 stocks currently. One of the stocks in the Dow is Apple. Another stock in the Dow is Chevron. They're trying to capture a cross section of America. And it's an index that has 30 stocks of companies that, for the most part, y'all probably know already. So 30 blue chip stocks began in 1896. I can tell you in 1896, it did not have the same stocks it has right now because companies like Apple did not exist in 1896. And here are three other examples of stocks within the Dow. NASDAQ, and just in case somebody needed to know how it's pronounced, N-A-Z-D-A-C-K, NASDAQ. So the first exchange to go online, so it's been one of the more technologically advanced exchanges. Also an index, a lot more companies in the NASDAQ. The NASDAQ also tends to be more centered around technology companies than other indexes, but it too tries to capture a cross-section of various industries and various sectors. 4 stocks that are in the NASDAQ: Apple, Facebook, Google, and Amazon. And as you could probably see, because I just mentioned Apple was in the Dow, a company can be in multiple indexes. More companies, Angie's List, 1-800-Flowers, and Starbucks. Starbucks being a non-technology company in the NASDAQ. So 4 steps to becoming an investor. Learn which investments are appropriate for your financial goals. So if you needed monies in the next 2 years or 3 years, you probably wouldn't invest in a technology stock, or you wouldn't invest in actually many stocks. And the reason is that stocks are more geared towards longer term time horizons, like 10 years or more. So thinking about what your financial goals are important. If you needed to buy a house and you wanted to save up money to buy a house in 2 years, you would invest in more conservative investments like cash or bonds. You would likely not want to invest that money in stocks, because in periods of 2 years, nobody knows. Stocks can lose money. So what are stocks? Stocks represent ownership in individual companies, and that ownership is expressed in terms of shares. So if you think in the simplest sense of a company like Apple, Apple has so many shares available in ownership of its company. And by buying a share of Apple, you own a fraction of ownership in Apple stock, in Apple as a company, by owning its stock. So stocks in general are high risk, high return. You can invest in an individual stock and lose all of your money, or you can make 10 times your investment. It's important to know that an individual stock has high risk, but also high return potential. Stocks are appropriate for longer term financial goals, such as retirement. So a lot of y'all are getting started in your income journey. Your quote unquote retirement is probably decades away. So having stocks in your portfolio when your savings are geared for retirement is highly appropriate. And as I mentioned before, it just may not make sense for shorter term financial goals. So stocks are not a great investment for your cash reserve. Stocks are not a good investment to protect you from for a rainy day. Stocks are not a good investment if you need the monies to put a down payment on a house in a year or two. Shorter term, not good for stocks. Longer term, fantastic for stocks. Bonds. So bonds are loans, essentially, that you're making, and they could be to corporations or governments. So when you buy a bond, you are lending money to a government or a corporation. They are paying you interest, and it could be twice a year, once a year. And then they promise to pay you that interest until the maturity of the bond. And so if the bond matures in 10 years, they'll pay you interest on the money you're lending them for 10 years. And then at the end of the 10-year period, you'll get your original loan back. So that's how you'd make money on the bond. Unlike stocks that are higher risk, higher reward, bonds are a little lower risk in general, not always, but in general, and they have lower potential returns. So bonds could be more appropriate for intermediate term goals like college funding, or think in terms of maybe goals that you have in 4 or 5 years, whereas stocks would be closer to 10 or more years. So bonds could also make sense as part of a retirement portfolio. You know, you may also have an investor that's just a little more conservative. And if they're more conservative, they may want to mix bonds to some extent in their portfolio. Cash equivalents. So think of cash equivalents as money you can get at anytime you want with minimum chance of loss, or a very low chance of loss. So that's typically money market returns. I would even call a cash equivalent like even your bank account, your checking or savings. When you go to take money out of your checking or savings account, you're pretty comfortable that money is going to be there, that it's not going to lose 10% of its value or 20% of its value. So cash is just it's a great savings vehicle for shorter term goals. So cash equivalents would be good for a rainy day fund. Cash equivalents would be good for a down payment on a home in the near term. So cash equivalents generally are good for things you may want or need in the next year or two. And in later years, like as you get closer to retirement or in retirement, sometimes it's good to have some cash so you have more liquid assets to draw upon that have a low risk of loss. So how do all of these rank? So I kept talking about higher risk, higher return, lower risk, lower return. So what does that all mean? So you can see when I mentioned higher risk, higher return, the annualized return of stocks over the last 92 years, stocks are the best returning asset class. So smaller US stocks have averaged 11.8% a year, larger stocks 10% a year. So if you have an asset that can average this return, you can make money really quickly. The risk is that they will not return this amount each and every year. This is just the average, and that's part of the risk. Sometimes stocks will go up 30%, sometimes they'll go up 10%. That's why they need a longer time horizon. So here's bonds, and treasury bills is also a special type of bond. Lower returns, lower risk. So you'll get a lower average return, but the variability of those returns will be smaller. And then inflation. So why do people invest? People invest because the purchasing power of your money goes down year after year. Or another way of saying that is that prices go up. Everybody knows, or everybody can see that over the years, if they look back, things are a lot cheaper than they used to be. So inflation is a measure that attempts to track the rate of increase in prices. And it has averaged 2.9% a year for the last 92 years. So that means we want to invest our money to, at the very least, keep up with inflation. So everybody says diversify, and what does that mean? And diversification is just a good way of saying don't put all your eggs in one basket. When you're investing, get a little bit of some different things, even if it's something that you wouldn't have initially put your money into. And the reason for that is we are in a world of uncertainty. And as certain as sometimes people feel like they know the future, the truth is none of us have an earthly clue what the future will look like. And if we ever go back in history and look at history's version of the future, it's usually way off. So because we don't know what the future will hold, we need to hedge our bets and invest in things that are completely different than one another. And that's truly what diversification is. And then I think there's an old saying with lifesavers candy, which is spread the risk to help protect your potential rewards. So whoever originally put this together was just a big Lifesavers fan. So also I think as you get into the world of investing, understand how the economy affects your portfolio. I think that's going to be a big part of the overall research. So 4 steps to becoming an investor, bulls versus bears. I think everybody has heard these terms. Bulls are optimism, markets are going higher, things are going great. Bears, we go through those periods where things are not so hot, and bears are generally synonymous with things losing value. Inflation, we just talked about that. Inflation is just higher price levels. So historically, the cost of stuff has always gone up. Generally, we've always tried to maintain low inflation so that people's purchasing power stays consistent or doesn't go down too fast. But there is always the possibility of high inflation. It's something that hasn't happened in a long time, but it's always a possibility where the rate of costs goes up a lot more rapidly. That's something we try to avoid. Interest rates. So what are interest rates? They're influenced by the Federal Reserve. This is very, very general, but when interest rates go up, stock prices tend to go down. And when interest rates go down, oftentimes stock prices generally go up. Why is that? Interest rates are what are paid on bonds and bank accounts. They're the alternative to stocks. So if people are being paid more money to not be in stocks, folks are going to take money out of stocks and invest in bonds and, savings accounts. But when interest rates go down and what you're getting paid on bonds and savings accounts goes down, people are more inclined to invest in stocks. And seek professional help if you need it. And what I would say is it's back to that example of I think I can do it all by myself. Thank you. I don't need your help. And I think that's okay as long as you have time to do the research and educate yourself. So some people will need it, and some people may not need it if they had the time, but maybe they're too busy and they don't have the time. And this is a story hyping LPL professionals. It's also what a financial planner can do as well, which is help you understand the different types of investments and their place in a balanced investment portfolio. Work with you to help determine your financial goals, such as retirement, buying a home, funding college education. There are so many financial decisions you're going to come across in your life. And a financial advisor is not just to manage your investments. A financial advisor is to help you navigate every one of those decisions. Help you determine an appropriate investment strategy. Meet with you on a regular basis to track progress and adjust as necessary. So it's an iterative process where through our lives, our finances, our jobs, our situations are entirely changing, and a financial advisor can help you navigate that whole process. And then we have a quiz which helps you identify what kind of investor are you. And by the way, everybody is unique. If somebody is young, don't assume you have to have all your money in stocks. And maybe if somebody's getting closer to retirement, it doesn't mean they have to have all their money in bonds and cash. We each have our own tolerance for risk, and it's important for us to be in tune with ourselves and be in tune with that, because that'll also help us make a good investment decision. So for example, if you're a really conservative investor, you may not want to have a lot of stocks in your portfolio, because then if the market drops a lot, it may make you want to shift around your investment strategy. And if you're a very aggressive investor, it may not make sense to have a lot of assets in your portfolio that are earning a lower rate of return. And this was a presentation especially prepared by LPL Financial, and it is not intended as ERISA, tax, legal, or investment advice. If you are seeking investment advice, it must be obtained on your own, separate from this educational presentation. And that is the end of the presentation. I wanted most of this to be a question and answer. So I'm going to give folks a little bit of time to send me by private message through this chat feature their questions. And I am going to run through as many of these as we can. So I'm going to give 20 seconds. Usually what happens in these presentations is there's a time afterwards where we need to take some time, absorb and think, and then come up with questions. Or some of y'all may have prepared some questions in advance of this presentation. Okay, and I'm getting a few are coming in. So I am going to start. Let's see. Do professionals, for example, a CFP, have access to additional stocks investment opportunities than if I were to buy stocks on my own? The answer to that question is absolutely not. So as professionals, we have access, I would say this, we have access to the same basic investment opportunities that most other folks do. I think the main difference is experience with it and ways we can guide folks in terms of the appropriateness of those investments. So I think the value that a CFP or a financial professional can provide in terms of investments and investment opportunities is more the education versus the access. Okay. I have a question. Is cryptocurrency a good idea to invest in? So I was planning for this question. I think it's hard to uh, make a specific endorsement of a particular investment. I think the most important thing, and cryptocurrency, I think, is a good example, is just to make sure you're educated about the investment and that you buy on research versus the narrative. So I think a good investment is one that you spend a lot of time researching and that you also view from a longer term perspective. So if you have an investment that you're interested in, don't buy it because everybody else is saying it's a good investment or because everybody else is buying it and making money quickly. Buy it because you've done the research and because you have 10 years or longer to wait out all the ups and downs in the investment, and that fits your time horizon. And then once you're there and you decide on the investment, diversify. So if you're actually going to make a purchase into something like cryptocurrency, make sure that your portfolio isn't just in cryptocurrency, that you have other investments in the portfolio. So look long term. Don't buy on the narrative. Don't just buy because other folks are buying, and just make sure you diversify. Okay? How do I know what company stock is quality when I know very little about investing overall? Is there a checklist that verifies if a stock is quality? So there is no checklist per se. And technically, every stock is risky. Every stock has a good bit of risk to it. So as a newer investor, I think the best thing you can do, well, one, in addition to reading, I think going to multiple sites that have good research on individual companies. And I mentioned one earlier in the presentation, Morningstar.com. And it's a place where you can look up a stock and then look up not only information about the stock, but analytical commentary about what the company is doing, whether the price of the stock is reasonable or not, and what the financial situation of the company is, whether it's strong or weak, and then just get that from other sources. I like Morningstar.com the most, but there's no checklist that will definitively say whether a company is quality or not. It's about reading multiple resources about a stock and then making sure that you don't only have one stock, that if you're going to have stock exposure in your overall portfolio, that you have more than one stock and that these stocks are all from different sectors and different industries. And just touching on that, so you don't want, you wouldn't want multiple stocks just in the same industry. You wouldn't want 20 technology stocks. You might want a couple of technology stocks, but then you may want some stocks in the food industry, or you may want to have some stocks in biotechnology. You're going to want to mix it up in that respect as well. Okay. Okay, so I'm 13. How do I use Morningstar to start learning? And what trading platforms do you recommend? So I actually, to start learning through Morningstar, if you use that apparatus, I would recommend getting their membership. And I think Morningstar's membership is like $15 a month. And starting with that, and they have a lot of research on individual stocks, and you can go from stock to stock, and there'll be an extensive commentary on a bunch of individual stocks, so you can look up stocks that you're interested in. And I think that would be a great way to get started on an interface through Morningstar. And if you don't have those monies to buy the membership, even the free service on Morningstar will allow some limited access to stock research reports. And there are also articles on the front of Morningstar, a ton of articles about the stock market, individual stocks, what's going on, and that is all free content. And by the way, I'm not a paid endorser of Morningstar. It's just a service that I happen to use myself. And it also goes to say that financial professionals are not necessarily to evaluate stocks always using much, much more sophisticated items. There's a lot of items available to the general public that are extremely good. Can you speak about trading penny stocks? Teens are very into newer apps like Robinhood. What should you know about how to use and plan? So it's actually a good bit of terminology here. So can you speak about trading penny stocks? I can. I would recommend not trading penny stocks. So I have a saying in the investing world where if people treat markets like a casino, markets will treat us like ordinary gamblers. The problem with penny stocks is penny stocks are not vetted companies, and some of them are, but most penny stocks are not vetted companies, and penny stocks enjoy a much more higher elevated level of risk, and a lot of penny stocks are not official companies. So if anybody has friends talking about all the money they're making in penny stocks, it's like going to a casino. You can win on one hand, and then you'll lose all that money back on another hand. Usually folks that invest in penny stocks do tend to lose the money they've invested. So I would not recommend investing in penny stocks. In terms of apps like Robinhood or Webull or Acorn, I think they're great. I think they offer a platform to invest, and they offer you access to different investments. I would just say it's just incredibly important to do your research on the investments and not to rely on as much on other users to provide that education. So they're great, inexpensive applications that allow you to start with smaller amounts of money to invest. And I think in that respect, they're phenomenal. I think it's just to be careful about content you see from other investors there, and to make sure whatever the investment is that you're doing your own research, and that also you're investing based on the appropriate time horizon. So don't ever invest in an investment where you're looking for what it can do for you tomorrow. Things will go up and down. It's really about what can it do for me over the next 10 years, because it's 10 years and beyond that's the most appropriate time frame for an aggressive investment. Hope I answered that question sufficiently enough. Another question is, why is 3 to 6 months of savings recommended, and does that change over time? I think everyone needs a rainy day fund. Everyone needs cash, because life changes and life throws us curveballs and things are unpredictable. So in addition to regular emergencies you may have around the house, like you have to replace an appliance, or you have to, I think replacing appliance, you have to clean something up that you weren't anticipating. You lost your job. You have an unfortunate personal situation that didn't work well. Things happen, and if you don't have a buffer, then what will happen is either you'll have a real problem, or you're going to have to go into your longer term investments to fund a shorter term need. And as an advisor, that's where I find folks get into trouble, because if you're in these riskier investments and you don't have a buffer, and then something bad happens and your risky investment has lost money, you're forced to then liquidate that investment to use it for something in the near term, and you never want to be in that position. So you should always have a buffer. 3 to 6 months is a rule of thumb, but it really just depends on where you are in your life. When you're younger, maybe you don't have as many obligations, you're not married, you don't have children, maybe you're renting an apartment. It could be argued that 3 to 4 months of cash reserve is enough. If you're married, if you have kids, if you have a job that fluctuates in terms of your income, if your job situation is less certain, then suddenly having a 6 to 12 month or even a higher reserve makes sense. So the number of months as a reserve is dependent on your personal situation, but with no exceptions, everybody should have a cash reserve. And by the way, cash reserve is literally a savings account, a checking account, something that is in the bank that is FDIC insured that you can get at in a very short notice and really not risk losing any money on it. Great questions. Can I invest towards a retirement plan as well as towards another goal at the same time? Or is it smart to invest solely in a retirement plan until comfortable investing towards another goal? It's a really good question. So I would absolutely say it makes sense to invest in multiple goals at the same time if you have them. So for example, a lot of folks, when you're working, you'll have a retirement plan, which is an investing medium sponsored by your workplace. And I always encourage folks to invest in their retirement plans. But at the same time, you may be saving to put a down payment on a house. You should do both of those simultaneously. You want to save for the house because you're going to need to come up with the money in a year or two. But at the same time, you want to be investing for the longer term as well. So actually something I commonly do is work with people to save for multiple goals at the same time. So absolutely, you should not feel you need to focus on just one. There's multiple goals, and some of them can be short-term and some of them can be longer term. And there'll be ways for you to do it simultaneously. And the level of risk on your investments that you would take for each one would be different, right? The shorter term goal, you would invest in safer investments. The longer term goal, you would invest in riskier stuff. Yeah. Great questions. So what is the minimum amount you recommend investing in each category, stocks, bonds, and cash equivalents? And this is going to sound like a cop-out answer, but the answer is it depends. It depends on how much risk you are comfortable taking, right? The more risk you are comfortable taking, the more of your money you want to put in the riskier asset. And then it'll depend on how close you are to your goal or what you want to do. So for example, if it's an investment that's a long time out, once again, more in stocks. If it's for an investment that's a much shorter time out, more in cash and bonds. So I think those two factors are the most important ones. How aggressive are you personally? In other words, and by how aggressive, I mean how much loss and fluctuation can you tolerate? And then how close is that goal to you? Those are going to be the two most important factors. Okay. I am concerned about inflation, but don't want to invest in crypto. Should I buy precious metals or something else? So that's a good question. And the answer, it gets back to diversification. So there are investments that at least historically have shown they can do better in inflation. Stocks are one of those. Another asset category that wasn't mentioned is precious metals. So I would say it's always going to be a mixture. And the reason is we just don't know for sure what the future is going to look like. But stocks and precious metals are two examples of assets that have shown at least the ability to potentially do well in an inflationary environment. And once again, crypto is something much newer. And it's not necessarily a recommendation not to invest in cryptocurrencies as much as it is just doing a lot of research and really, it's really just making sure you diversify across multiple assets. I'm looking through the questions. I'm thinking we may have gone through them. Let's see. How can I make a smart, risky investment? Okay. I would always say good research. And by the way, diversification doesn't mean you're cutting off your upside. I talk with folks about this a lot. A smart, risky investment could be diversifying. So, for example, let's say you like stocks, but instead of just buying one stock in one industry, you buy 10 stocks in 10 different industries. Just by adding the 10 stocks in 10 different industries, you may not be cutting your upside, but you're being smart about it because you're taking an aggressive asset, but still spreading your risk across different parts of that aggressive asset. So that's one way of making a smart, risky investment. I think another way of making a smart, risky investment is just doing a lot of research and not buying into the narrative of what it can do for you tomorrow. Generally, if you're hearing about an investment that's making all of your friends a lot of money in a very short period of time, that is probably not going to end up being a good investment long term. So I'll repeat that because it sounds counterintuitive, but if there is an investment that all of your friends seem to be making a lot of money in very quickly, that is generally not a smart, risky investment. Okay, smart, risky investment is seeing the best ways you can diversify, doing your research, and if it's a risky investment, making sure you have the right time horizon over which to invest. I hope that answers that question. If not, just send me another question that it didn't. Okay, so another question came in. How much should I save as a percentage of my money earned? That's actually a really good question. For those of you who are getting started in their careers or earlier in their careers, even starting with 10 to 15% of your gross earnings in savings is a good place to start. And when I say starting in your careers, I mean in your early 20s, early to mid 20s. I think that's a great place to start. And the reason is you have so many years to compound, so many years for your money to grow, that it'll help you grow. It'll help you grow your assets significantly over the years. And I think it's a great time to budget for that and start looking at doing that. Because if you don't, that percentage requirement goes up significantly as you go on later in life. So I don't have a specific study in front of me, so these are just guesstimates. But if you can get started in your 20s saving at least 10 to 15% of your income, that compares to starting saving in your 30s or even your 40s, where then your requirement will be up to 30% of your income. So when you start to save young, you can save a lot, but then you can also spend money and enjoy life as well. So the younger you are, the lower that percentage is, but I've always recommended folks 10 to 15% is a great starting point. And that's a great thing to budget to. And by the way, I recommend everybody put together a budget, which is just your own estimate of what your ongoing expenses are, because it's a very powerful thing to do. Knowing what you're spending your money on is helps you best keep track of it. Otherwise, you lose track of it, and it's like a bad diet, right? You know, you don't know what's going into your body and how you're taking care of yourself. And it's the same thing with a monetary budget. And one thing I'll mention as a financial advisor is something we commonly do for folks is projections, which we look at people's budgets and we say, okay, how much you were able to save now? And we show them how this money can grow over time. And it's really a very powerful presentation when we do. Okay, I have a question can you talk a little bit about what different career options are available in finance? Potential college majors. So I recommend, if available, firstly, that everybody, if there's ever a financial planning course, personal financial planning in college, I'd always recommend folks taking that, because there, at least when I went to college, there was so little of that. To be a financial planner, which is what I am, which is giving people advice on their finances. You know what? I just had a degree in, an undergraduate degree in economics. And I would say economics, finance, even business are great courses of study. I didn't get a degree in financial planning per se, but those provide a very good underpinning and just a good initial education into that. Just looking at the question again, career options available in finance. There are also financial analysts, which are people that get paid to analyze stocks and investment opportunities. That's actually a great career option for some folks. There are financial planners like myself, which are people that give advice to other folks on their finances. There are folks that advise companies. So for example, if a company is going public, which means they become a publicly traded company, there is positions in finance that will, they're called actually underwriters that can help with that process. And I think with careers in finance, I'm a big believer in degrees in economics. I think those are very powerful. I think finance, but I think if anybody's undergraduate school offers a degree in financial planning, I think that's just a really powerful option. And I'd be happy, by the way, to talk more in depth specifically about that, because there is just a ton of options in the financial space. Okay. By the way, one other college course that I felt helped me a lot was human behavior too. So I think, you know, if you're going to have a career in finance, it doesn't always have to be a course. You don't only have to have courses that are specific to the mathematics and the numerical aspects of economics and finance, but I've found that courses in human behavior, how we relate to one another, I've found that to be incredibly helpful as well. And I'm actually trying to think of the name of a specific course, but I've found that anything dealing with human interaction, human behavior, psychology is actually useful as well. I think I covered a lot of the message questions, or I think I covered all of them. Let me ask this. Is there anybody that would like to unmute, or if they had any other questions that maybe I didn't fully deal with that would like to express a question or a thought or an idea?
I would, Gary.
Yeah.
I tried to send a question, but I think it went to a direct participant. Should I factor in Social Security income when I'm thinking about my retirement?
That's a good question. I think when planning long-term for retirement, and let me define Social Security first. Social Security is basically a payment plan by the government that it's basically retirement income pay, okay? We when you have a paycheck, some of your paycheck is withheld for Social Security, and essentially what the government is doing is saving it up so it can pay you later when you're in your retirement. And right now, retirement is defined as after 66 years of age. So it could be pretty far off for a lot of folks. But when we plan with folks, we definitely include Social Security as part of that, because it is part of it right now. And it gets back to the, certainty, uncertainty about the future, right? Some folks have different opinions about Social Security, but right now it is part of the infrastructure. So yes, we include that in the planning process. And I always encourage folks to plan together with it, but not necessarily depend on Social Security. And that's another question, which is I wouldn't encourage anybody to depend on Social Security for their retirement, but to use it as part of the planning process, yes.
Thank you.
Sure. Anybody else? Any more questions through message or voice? Okay. I just wanted to thank y'all, and I think everyone has my contact information. They have Patty's contact information. If there were questions that come up after this, or things that weren't answered during the presentation, or just simply something you want to go more into depth on, just send us an email or give us a call, and we'd be happy to talk with y'all. And we have a lot of great educational resources and materials, so that would be great. And also, one other note is we'll be having webinars every other month, and we're going to try to make it on a different topic, and hopefully just for topics that are timely and that are of interest. So if any folks have topics they are interested in that they would like to send us, it could probably end up on a future webinar. So we'd love to. And yeah, feel free to email or send any other questions. We'd love to hear from you guys. Thank you both. Thank you all so much. Thank you for taking time in your evening. And hopefully I'll have the chance to speak with you soon. Take care.
Thank you.
Thank you.
Gary.
Very
Thank
much.
you all very much.